central banks will have to take the independence they have and exercise it. So they'll have to do what needs to be done and at the same time explain to the people and the politicians why that's necessary and why they told them ahead of time that's what they were going to do. Central banks have been in uncharted waters for 4 or 5 years now since the crisis intensified, and trying more and more things to get the economy going, to stabilize the financial system. So what we're talking about here is what would be a very good situation to have. That is, when economies recover, when financial systems are stable enough that central banks can think about not doing these unusual things anymore, and then unrolling the unusual things they've done, exiting back towards a more normal monetary policy. The first part of the conference was about when central banks exit, what should they exit to? What do we mean by a normal monetary policy now that we've been through this very unusual period? The second part of the conference, the part that I was addressing, was once we decide what the new normal monetary policy is, how do we get from these very unusual situations to that new normal? What challenges will be presented to central banks to make that transition? First set of difficult decisions facing the central bank will be to decide when it's appropriate to exit. What are the economic conditions which will cause them, A, to stop doing what they're doing now, and then B, to start unwinding those things? There was quite a bit of discussion at the conference about this. Some people who were very uncomfortable with what central banks are doing couldn't wait to see those policies unwound. Other people felt that the policies were doing some good, the situation was very bad, and that central banks had to be careful not to exit too soon from the policies that they had, or economies could be thrown back into recession. There aren't any easy answers here. Tightening policy is always difficult to decide. Changing direction in policy, tightening policy, always difficult to decide. And I think in this case, it'll be more difficult than usual because of the unusual character of the policies and because of the unusual period that economies have been through. Because central banks have been doing a lot of unusual things, they have more levers that they need to pull when they start exiting policy than usual. Usually you just decide when to raise the short-term interest rate, and you have an established set of instruments to raise the short-term interest rate. This time we have a lot of assets on the balance sheet. We have a different combination of assets, different makeup of the balance sheet depending on what particular problems the central banks are trying to do, and we have interest rates at zero. So the tools we need are tools that will raise interest rates, reduce the balance sheet, unwind policies that favor some borrowers over other borrowers, and renormalize the balance sheet, rebalance the balance sheet towards a more sustainable situation. Central banks have the tools to do this. There's a question about what order you should do them in, and whether you should return to focusing just on the short-term interest rate. A lot of participants at the conference, I think, agreed that you should return to focusing on the short-term interest rate, the policy interest rate, but it won't be that easy. How do you raise that interest rate when there are all these reserves in the system? So you'll have to do something about draining the bank reserves that have been put in there with unconventional policy. You'll have to do something about shrinking the balance sheet at the same time that you're raising interest rates, most likely by raising the rate you pay on deposits that are held at the central bank. Raising that rate will be sufficient to put upward pressure on interest rates. And certainly once central banks start that, markets will anticipate there's more of that coming, and that will get built into intermediate and long-term rates. But having everything work together to shrink the balance sheet at the same time interest rates are going up will kind of reinforce, one tool will reinforce the other, and we'll move more quickly back to a more normal stance of monetary policy or instruments of monetary policy. Quite a few participants at the conference were concerned that the unusual policies central banks have employed in terms of buying assets and making loans, and then the exit from those policies, shrinking those, would have very adverse effects on the fiscal situation of governments and bad feedbacks from the governments back on the central banks. It is critically important that central banks maintain independence. What I mean by that is central banks should be given overall goals by the elected representatives of the people for price stability or whatever those goals are, but then they need to be given independence to pursue those goals, to move their instruments, to raise and lower rates, to decide how many assets to purchase or how many assets to sell. A long history suggests that across many, many countries and jurisdictions suggests that when the politicians control the central banks, when there isn't independence, it is highly inflationary. Politicians don't like to tighten policy because it could hurt jobs. They're concerned about it hurting jobs and their re-election prospects. So maintaining the independence, the ability of the central banks to move their instruments around, to tighten policy when they think that's required to maintain price stability, maintain financial stability, make sure that the economy doesn't overheat and overshoot its employment goal is absolutely critical. How to maintain the central bank independence? This is obviously a political decision to maintain it. I think that a critical element in this is telling the people and their elected representatives what's going to happen. So central banks should say to folks, here's the consequences of what we're doing, here's what's happened to our balance sheet, here's how we're going to exit, here's the consequences of our exit, not only for interest rates and financial markets, but also for the fiscal authorities, so that nothing comes as a surprise, either to the markets or to the fiscal authorities, and everybody is aware ahead of time what's going to happen. Now, that won't prevent the politicians from complaining, that's for sure, but at least the central banks will be able to say, we warned you, we told you why we were doing what we were doing, and how this would affect you when we drew it back. So I do think being transparent about exit plans ahead of time, putting something on the table about how you're going to do it, will be helpful to maintain independence over the long run. But it's likely to be politically uncomfortable. Central banks will have to take the independence they have and exercise it. So they'll have to do what needs to be done and at the same time explain to the people and the politicians why that's necessary and why they told them ahead of time that's what they were going to do.